After this panel, there will be a note from the European Commission, and we hope to hear a little bit about the current thinking, plans, and the overall policy context in which this debate is taking place. But before we get to that, we will have this quick discussion between two really important initiatives in this field. They almost share the acronym, but they are, of course, very, very, very different. I think I don't need to introduce Global Reporting Initiative, which is the most commonly used standard or referred to standard, as among other things our research showed. When it comes to principles for responsible investment, I suppose that everybody in the room knows about this initiative. It's a leading initiative that aims to drive this kind of thinking in the investment community, and I believe that Kris will tell us a word or two about his discussions with investors on these matters. I would like to kick off this hopefully exchange, not just not just presentations, by setting out a couple of things that I felt that resonated. Well, first of all, I would then like to ask you to perhaps reflect on some of the results that you've seen. But really, what's important is to dig into the question: what information is necessary and why, from your different perspectives and from the different constituencies you represent, and specifically with investors, why the investors actually need that certain specific information, and then perhaps we can look. Maybe in the second round, look a little bit deeper into some of the key topics that were raised, such as business model, information on progress versus information on plans, and how these two relate, the information on effectiveness and evidence, how can we get to it, and maybe also to touch the issue of specific KPIs, or the role of the KPIs, and flexibility versus standardization, which seems to be the biggest challenge here. So that's the frame from our discussion. Feel free to stray away from it. I won't hold you back. And I have a couple of questions prepared, but I just thought it would be best if you tell us what's most important from your perspective. So maybe let's start with Asthildur, if that's fine with you.
Yeah.
Bring it on.
Okay, so thank you so much. Yeah, I thought the research obviously was very interesting, came with some very interesting results. And obviously it's very early on in the implementation of the framework, and it's interesting to see how the regional difference, for instance, because if you look at the Nordics, who are doing very well compared to other parts of the world or parts of Europe, then that could also be because this type of reporting is a mature practice already in that part of the world, and we have already noticed that there has been less uptake on corporate or CSR reporting in, for instance, Central and Eastern Europe. So that could also reflect some of that. So, but I think it's a very valuable a baseline study. And I'm very happy to see that there are plans to continue with that. And so there were many, actually a lot of the results that were not quite surprising, I would say, but a very, very That's good true. Starting point. Yeah, and of course very happy to see how many are using the GRI standards, obviously. Yeah.
And specifically on the kind of information, I mean, it's kind of reflected in our report, and frankly, our report didn't bring any staggering findings that somebody would be surprised with. It's, I guess the value is rather that we did the work and actually show that what people think is the reality is actually the reality of the quality of corporate reporting. But I wanted to ask you more specifically about the kind of information that you think is key and frequently missing. And I understand that you have your own insights into corporate practice, corporate reporting, so not only building on the report, but your own experience.
So obviously, the GRI standards are principle-based, and there are principles when it comes to the content of the report, and there you have the sustainability context principle, the stakeholder inclusiveness, and the materiality principles. For instance, they're of course crucial. And so the materiality principle, which is kind of the fundamental principle for GRI, is already includes the concept of the impact. And the impact, of course, could be positive, negative, long-term, short-term. There are all kinds of angles to that. And in the materiality principle of GRI, the impact the company should be reporting on or focusing on is the impact that they're responsible for, not how they are impacted, which is also brought up earlier in previous panels. So that is something that, but we see that actually that this is something companies struggle with anyway. So we find that when we are looking at this, and just like you in your research, people are not reporting to GRI. They use our standards to report to their stakeholders and to anybody. But so it's often misunderstood that people that we are in some kind of an authority of the reported information, but that is not the case. People use the standards to report, but they're not. So we do not verify the quality of the reported data either. But we obviously sometimes look at the reports and then we see that that this misinterpretation of the concept of impact is very, very common. So that is that's definitely something that needs to be. We do our best to try to kind of educate people on that, and yeah. So that's. But also the context, and then the issue of KPIs and reporting on numbers, etc. If you don't put that in context, then it's very difficult for anybody to interpret the numbers. You know, is this good? Is this bad? What does it mean, etc. So this is why there are specific disclosures in the standards, that the management approach disclosures, that are underused, I would say, and very sadly, because this is actually where the company can explain how they are, or first of all, why a specific topic is material to them, how they are managing that, and also where it is important, where it is material. And that's very important when we think about issues such as the supply chain, because it's very possible that that topic is very, very material to you, but not within your own organization, but actually further down your supply chain. And if it is the case, then you obviously need to take measures. And then last but not least, one of the elements in the management approach disclosures is the effectiveness of your approach. Because it's fine to have all kinds of policies and procedures, etc. in place, but if you never step back and actually evaluate, are they really effective? Are they really getting you the results that you are aiming for? Then of course they are pretty useless. So these are kind of maybe some of the things that I would like to highlight.
Excellent. I already have a follow-up question for you, but I think that Kris might weigh in on the very subject of my question. So Kris, what's the most important issues that you see there, and specifically from the perspective of responsible investment? What kind of information is really, really important, and what is it that investors say actually?
Yeah, well, thank you. So we recently did a consultation with our signatories, and for your background, so we have about more than 2,000 financial institutions who are signatories to this UN-related organization principles for responsible investment. Together they manage about $80 trillion assets under management. So it's a large chunk of institutional capital globally. So we did a consultation with the asset owners, pension funds, insurance companies, and also worked with the CFA Institute in the Americas. And it was clear that the major obstacle for responsible investment at this moment for adequate integration of ESG factors is actually the quality of data, not the amount of data, but the quality of data. So this is at this moment, it was fiduciary duty a couple of years ago. That was the major problem then. That is sort of getting resolved. So data is now the number one priority. And if I look at the research that you've published, I can hear a lot of people saying, well, it's not good enough. I'm also happy to see that there has been a lot of progress in the last couple of years. So let's also say that. And from an investor perspective, I think there are 5 steps in the quality of data. So you want to know about awareness about a certain issue. So if you look at ESG issues or whatever issue you have, it's about awareness. You want to have a company to have a policy in place, adequate implementation. Then you want to see the results, and preferably assured. So these are the other 5 steps. So what you can see in the reporting is that at the level of awareness, the scores are already relatively high. But there's a lot of things that need to be done beyond the awareness, moving to policy implementation, results, and assurance. So that is, I think, the important part. So, and what I would like to say additionally is that because of this importance of data, we've looked at, so what do investors need? So maybe for your background, there is something like the Corporate Reporting Dialogue, where 8 reporting organizations, CDP and GRI and SASB, and Integrated Reporting Council, International Accounting Standards Board, ISO, IOSCO, where they collaborate to see if they can create more convergence in their reporting. And that process is going relatively slow, but a while ago they said, well, it's not an easy thing to do because we have these 8 standards and we want to do the convergence, but how are we actually going to do that? And they said, we get so many different signals from investors about what they want. So that's sort of a barrier for this collaboration. So that's when I brought together 7 global investor organizations, including PRI, but also the Global Impact Investors, and UNFR, where the banks and the insurance companies are. So 7 global investor organizations to see if we can come up with a bit of a guidance on what we think as investors, as a joint investor community, think is important. And I think the element that strikes me most, 2 elements I will take out of that learning, because there's lots of things to say about that. But one is the analogy with financial accounting. So there has been 100 years of experience in developing adequate financial accounting. And in the ESG space, we're relatively new compared to that. But we can learn from that experience. And in financial accounting, there's a couple of things. One is there's a distinction between an annual account and an annual report. And in the annual account, you will find the data. And in the annual report, you will find the storyline. And I think I heard you say, Martin, it's about the storyline backed up by evidence. And I think that's basically what is the common practice in financial accounting. The report provides the storyline where the major and material issues for a company are addressed by the management of the company, by the board of the company, and the annual accounts provide the basic data to underpin and provide evidence on those issues. So I think that analogy can be used very effectively also in ESG. And I think at the same time, it solves one of the additional challenges, and that is, I think there are maybe 4. One challenge is we need one global comparable standard for the annual account part. And I think we are working on that with the CRD and investor groups, and I think the GRI standards already provide a very good basis for that. So let's not try to reinvent the wheel. There's 20 years experience in actually doing that. More than 50% of companies use that. It has a multi-stakeholder approach. So I'm making an advertisement for the GRI here because I think that they are well positioned to provide that basic data concept. So the second thing is about integrated thinking. And I think once you have that link between the storyline in the annual report and the actual data in the annual accounts, you almost force the board of a company to do this in an integrated manner. So it will be an issue of what gets measured, get managed. And then the boards will get on board. So the integrated thinking, I think, will be part of that. Then there are 2 additional challenges, and that the SDGs and the sustainable outcomes. And I think we're in the early stages of thinking about that, but we have to think about, okay, how do we incorporate SDGs into those reporting standards? I know you and Global Compact and GRI are working on that. We very much support that. And there's a group of people, and I would also like to reflect that consists of United Nations Development Program. They know what the SDG challenges per country are. The GRI is involved. UN Global Compact, the companies are involved. We as investors are involved. IFC, who finances a lot of these relevant SDG issues around the world, are involved. And together trying to develop a reporting standard for what is actually impact. Somebody said, I think it was Suzanne, said that there's a risk of SDG washing. So we have to have a very clear standard of what qualifies as SDG-related impact. So there is work going on that. And finally, the financial, the translation of these issues in financial terms. I agree that we should not try to do everything in financial terms, but there are certain elements that can be brought to this financial accounting industry. For instance, if you do an investment in a refinery or something, you can think about what is the write-down period for that. Because if you talk about stranded assets, you can think about what is the write-down for those investments, etc., that you have to apply. So I think there are a couple of challenges, and people are working on that. So I'm quite optimistic, and I think the time is actually there to start harvesting on all these good initiatives and work towards the global standard.
Excellent. I think we have two topics now we can exchange on. I'll start with the broader one, more general one, and that is the question: how can legislation, right here, right now, next 2 or 3 years, because that's essentially the context we have, give power to these standards, both existing as well as those in process of making. It seems that these standards are actually quite well aligned. That is what we found when we were creating the methodology for our research. At the same time, what can be seen from the results is that no matter how good the standards are, how good the guidance in the standards are, certain elements of those standards keep getting ignored by companies. So what is, let's say, what could be the intervention, legislative intervention that can give some force to this? I know it's not an easy question, but maybe you'll have some fantastic thoughts.
Well, I think, for instance, legislation, regulation, anything is an incredibly powerful driver for change. Because, when things remain voluntary, we rather just do what we have to do, right? That's sort of the human instinct. So what we are seeing, and we obviously are working we're working globally as GRI, so we're also working in different continents. And we see that, for instance, in Asia, in Southeast Asia, there is an incredible drive or urge to catch up, basically, with what's happening, for instance, here in the old world or in the more developed markets. And we see that there, for instance, stock exchanges, regulators, etc., they're very active in this, and to mandate, for instance, for listed companies that they do some type of non-financial reporting. So that is definitely a given that it will definitely help. And we have also discussed, for instance, the scope of the directive, the non-financial directive here in Europe. Is it the right scope? If we would widen the scope, would that maybe even more impact? But then to kind of get back to also a little bit the quality and the uptake and the usage of the standards, because like you say, you can have a wonderful standard, but if it's not being correctly used or underused or whatever, I think that also comes down to education, capacity building, etc., to help people understand how these standards should be used. I think that's also something that shouldn't be overlooked. And when you basically mandate or oblige people to take up a new practice, and I think that's probably could be also the reason for the low quality of the reporting in some of the countries or companies that you took into account into your research, is that they just don't know how to do it. So they don't know where to begin. So I think that is also something that needs to be taken into consideration as well.
Well, I would say that this requirement to report creates a market for education, which can be filled in by policymakers, not by the civil society, but let's say by consultants, perhaps by GRI, and so on and so forth. And the challenge I see is that when the legislation is not clear about what it requires, then it's hard for the educators to educate, and they just dumped all this information on this. My experience with the, let's say, CSR industry, consultancy industry, is that they just, pick whether GRI or another thing, and they just dump it on companies in almost driving them to do the tick boxing exercise, because they rather look at the quantity of their GRI-related information rather than the quality of the process that you mentioned, the managerial disclosures and materiality assessment and so on and so forth. Let me throw the same question your direction: legislation and standards. So there's standards being developed, and there's the legislation operating in the same field. And the legislation will probably sooner or later include even some concrete indicators, especially on climate issues, because that's what's happening. So what is the interaction here? What do you think is the most smart use of the legislation?
Yeah, I think again the analogy with the financial accounting is useful, and that is the standard setting is done by the International Accounting Standards Board, but there is still a mandatory element to that. So although it is an independent body developing the standard, it is required to report against those standards. And I think something similar could apply in this area if we agree on what, I think, first of all, and to reiterate that, we have to work towards this standard. And I think, as I said, GRI plays an important role in that, but we have to bring the intellectual property to the table to further develop that. But when we have the standard, and I think the standard is already good enough to have that effect, then I think governments can say, well, we're not just saying non-financial reporting directive, but we're saying there is a standard, and you should report against this standard. And I also think this is important because that was an element that I forgot earlier in my introduction, and that is the element of assurance. And investors need assurance on reporting. And there is only one way that I've worked in the audit industry for a while. And if you talk to an auditor will say, I cannot audit and give assurance on anything where there is not a standard. So I think the European Commission would be very wise, in my view, if they would say, well, we can see what the standard is that is currently being developed in the world, and it has to improve, all said and done, but we make the reporting against this standard mandatory. And for the material ESG issues, it is of course already mandatory through this financial accounting work, but for the other issues, and especially also for the impact to society, I would say, yeah, pick the best standard available and make it a mandatory reporting standard.
Yeah, I would perhaps, from my own perspective, add to that yeah, the legislation shouldn't probably come up with something that's in conflict with those existing standards, because they would create even bigger mess. But perhaps instead of just mandating reporting against certain standards, the legislation could build on those standards and just kind of distill a couple of, let's say, pivotal points or indicators or requirements that are based on those standards. But that would be my thinking. I'm interested.
Well, I think so many companies are already using the standards like GRI or some others more niche standards, that if the Commission or any government would start to kind of pick some elements from that and maybe tweak them a little bit, they would not be doing the companies any favor. They would not. I mean, they are already reporting. What would be the benefit of that? My question.
What's the alternative?
So I agree with you. That's it. I would say that there has been 20 years of work put into that. And it's a multi-stakeholder approach. The International Accounting Standards Board works similarly. It has a multi-stakeholder approach to develop the standard. If you want to do that in a 5-year policy cycle of a European Commission, I would say, please, let's not do that. This is a continuous process with an independent standard setting board. That's a much wiser approach, I think. And most of the work is already done.
Exactly. And for the way, for instance, that we develop any type of standards, regardless what the topic is, that we actually convene working groups with the best experts in the world. They come together from all over the world. So, and there is a public comment period. It's a really strict due process behind all of this. So this is nothing there is developed by me or my colleagues, because we are not subject matter experts. So there is already a very robust process behind this.
And to avoid misunderstanding, I don't have shares in GRI, but I think
we're a non-profit. We don't issue shares. But anyway,
let me reformulate the question, though. I think that we're actually speaking about different things here. So, one extreme, you can take a standard such as GRI, and just make it mandatory for companies to report against the GRI using the GRI's criteria, managerial disclosures, materiality, and so on and so forth. It runs into a problem that it's not the only standard out there, and you can't entirely privatize, the development of the standards take into account what you have said about the stakeholder inclusiveness and so on. So that's one extreme. The other extreme is the NFR directive as it is now, which is, saying companies, pretty please give us some information. It's entirely up to you. And if you use some standards, just tell us which standard. So my question was aiming at essentially identifying which elements from these standards can be translated into the legislation, not changing them, not developing some standards on top of standards, but we can't mandate the whole GRI framework because it hasn't been designed as for legislation. But there are obviously common problems with the application of that and other standards, precisely in terms of consideration of materiality, managerial disclosures, quality, informational effectiveness, and so on and so forth. And so this is the question I'm most interested in. What is here the connection between the standardization, harmonization processes that are going on and the legislation that is kind of trying to do the same but using slightly different means? Well,
like Kris has mentioned, the digital reporting dialogue that's ongoing, but GRI, for instance, is already aligned with many of the other instruments, for instance, the UN Global Compact, the UN Guiding Principles of Business and Human Rights. Sure. And so that's already, a lot of it is already integrated there. And even if you were to mandate reporting by using the GRI standards, you would never be obliging anybody to report on all the standards, because the fundamental issue of applying the standards is the materiality assessment, and you actually have to report on the process, how you come to your material topics. So this is basically just giving you a menu to choose from, and the ambition of GRI, that's one of our objectives, is to make sure that our standards are always relevant. So that's why we continuously improve them. Or we also develop new standards on issues that are emerging, that are not yet covered. So for instance, now we are soon will be issuing a standard on tax and payment to governments, which is absolutely brand new and not existing anywhere. So this would be one of the advantages of what Kris is saying, that to just basically jump on something that is kind of tried and tested and has a robust process behind it, rather than coming up with something new and maybe similar.
I'll press you on this. So, there's a GRI standard, which is wonderful.
Of course. Standards, there are many. Yes.
Almost no company is doing justice to that standard, or very few companies. Very few companies doing. Very few companies are doing so. Now, if you align this standard with the others, which is happening, which is great, or if you develop new standards for new, let's say, salient issues such as tax issues, it's probably not going to change the fact that companies are not, genuinely reporting against the standard. They just claim to be. And here comes legislation which can make the companies to use those standards more in a way they were intended to be used. And I'm interested in a mechanism that can be integrated in the legislation that achieves that. Wow. And that does not mean developing a competing standard with GRI. And maybe we don't have an answer for that.
Do you have anything in mind? I'm really intrigued. Yeah.
But because you say, let's use the standards. In the last I'm not satisfied with that answer.
Yeah, but in the last, that's why, again, the analogy with financial accounting. I mean, and the same for corporate governance codes, by the way. So they were developed. Usually they were developed independently. So the international accounting standards, the corporate governance codes, they were developed independently. But they all receive backup from governments through their regulation. And they may do it in different ways, but at least it is a mechanism that has proved quite effective in financial accounting and in corporate governance standards to say, well, these are codes that are and standards developed in the industry where people bring their expertise to the table, and then they get the leverage of mandatory force by regulation. And so I'm very much in favor of that, actually, because I think that will bring those statistics in your report in a couple of years to 100%. And without the regulatory support for these, I mean, we may struggle for a couple of years along this line with gradual increases. But I think that making it mandatory will create higher scores in a relatively near future, and we need that.
All right, so I think I'm getting it now. So essentially, these standards is something that we need to build on, not in terms of changing them, but in terms of actually seeing how the legislation can more forcefully require reporting against them in a way they were intended to.